Well, welcome to our webinar. This is all about tax in 2022 and what you need to know. I'm delighted to be joined today by Nimesh Patel, who's a partner here at Grunberg & Co. So welcome, Nimesh. He's going to be delivering our webinar today. A couple of housekeeping issues. We're due to run for about 45 minutes this morning. This webinar is also being recorded, so we'll make a copy available on demand on our website later on today. So if you need to recap on any of the points that Nimesh has made, that'll be available to you later on. We've also hopefully got some time to take some questions before the end of the webinar. So if, as we go through, you think of things that you'd like to ask Nimesh, please just use the Q&A option on your Zoom toolbar to put your questions forward, and we'll try and get to as many of those as we can before the end. So I will now hand over to Nimesh, and I will see you at the end for any questions. Over to you.
Okay, thank you, Jo. Welcome, everyone. Good to see you. Very good turnout today. This is the end of a tax year, which we're approaching now, so lots to think about. There are plenty of changes that are going to be coming up as well. So it's a really important time. Obviously, a lot of squeeze on business costs, personal costs. So thinking about how to mitigate these changes. One of the costs that can be reduced is tax. And the purpose of this webinar is to actually give you some guidance on various ways people can reduce their taxes. There's many ways, but what I'm going to do is to give you a run through of the common techniques that are used each tax year, just to make sure you're fully prepared for the upcoming tax year. And if you need to take any action, then you do have some time before the 5th of April. So next slide, please. So what are the substantial changes in taxation that are going ahead? So if you look forward to the next slide. So these are the headline changes, and some of these you may know about already because they have been previously announced. So corporation tax, that's going to increase for many companies. For those companies that have a profit of more than £50,000 per annum, in April 23, they'll see an increase in corporation tax. Dividend taxes are due to change from the 6th of April, and the rate of tax will increase by 1.25%. So when limited company shareholders take dividends, or when shareholders of listed investments take their dividends, the dividends that are payable after 6th of April are going to be taxed at a higher rate than those dividends that are payable before the 6th of April. So one of the things here to consider is the dividend strategy for those that run limited companies, and whether it's beneficial to move dividends to the current tax year to mitigate the increase in tax rates from the 6th of April. The next major change on the list is the changes to capital allowances. So you may have heard about this thing called a super deduction. It basically gives you an extra deduction for companies that are spending money on plants and machinery. So it's there to help businesses to reduce their corporation tax when they're trying to go out and invest in their business. We're in times where many businesses are trying to recover and to gain back, the stagnant growth in their business. So the aim there is to help businesses to grow and to give them the confidence that the government's trying to back them in some sort of way. The final two changes here, personal allowances being frozen. What is the impact of that? Well, normally personal allowances would increase over time, and it's basically there to be there because there's inflationary pressures every year. So a freeze on the personal allowances has an impact because you're going to be actually not realizing any saving in tax for lower earners like you would do in previous years. And obviously with the personal living costs going up, that freeze on personal allowances is going to have an impact on everyone that would normally claim those allowances. And the final one on the list, making tax digital. So this one has been around for a few years in terms of VAT, and there's going to be a further expansion for those that are landlords and sole traders that are paying income tax, and also companies that pay corporation tax. And that will also come into play. The original intention was to bring it into play into April 23 for sole traders and landlords, but that's been pushed back. But these are changes that are still going to happen. So it's making sure that businesses are prepared when those changes eventually do happen. So if you move on to the next slide, please. So what we want to do is to give you a guide to the planning that could be undertaken at the end of a tax year. So we haven't got long left, as I mentioned. We've got a matter of weeks until the end of a tax year. So what we're trying to do here is to give you some tips. There might be things I'm going to mention here that you could be doing based on your circumstances. So there are plenty of things that can be done, but you need to have careful planning to achieve these tax savings. So first of all, we'd like to look at businesses and what tax planning they could undertake. So first of all, I mentioned dividends earlier. So there'll be an increase in the rate of dividend tax. So those that pay 7.5% as a basic rate payer will have an additional 1.25% added on. And the same applies for high rate taxpayers that pay dividend tax at 32.5%. And it also applies to the additional rate taxpayers that pay tax on dividends at 38.1%. So somebody whose income is more than 150,000, they would have to pay tax on dividends at 38.1%. And that rate is going to increase by making it, 38.1 plus another 1.25%. So we're approaching nearly 40% here. So you can see, there's a real thing to look at here is, should we actually be taking dividends out in the same way as previous years, or should we be doing something different? And also the increase in dividend tax in the following year, that could be mitigated if you haven't taken any dividends in this tax year, because every tax year, an individual can receive the first £2,000 of dividends tax-free. So if you do have a limited company and you haven't taken dividends in this tax year, then as a minimum, we actually recommend taking the 2,000, which means less dividends are taken after 6th of April when this increase in rates takes place. So as I mentioned earlier, corporation tax is due to increase for those with profits over £50,000. So the way it will happen is if the limited company has a profit of more than 250,000 per annum, then the rate is 25%. If the limited company's profits are between 50,000 and 250,000, you will have a rate of 25%, but there'll be something called marginal relief, which means that you'll get a reduction from the 25% rate. And what that means is for those companies with a profit between 50,000 and 250,000, by applying a mechanical calculation, the overall rate of tax will be somewhere between 19% and 25%. In terms of capital allowances, we've had this thing called the annual investment allowance, which allows companies to claim 100% deduction for the amount paid on plants and machinery. And that allowance has been £1 million per annum. That's going to be extended until March 23 to give that support to businesses. Also, as I mentioned, there'll be the super deduction as well. And under the super deduction, corporation tax relief can be claimed, and so that 130% of the expense can be deducted. Another thing to mention is research and development. So there are companies that carry on innovative projects and try to develop new products. And this is an area of corporation tax where, despite records amounts being claimed, the Chancellor's actually released an article or released a press statement to actually say that this is still one of the most underclaimed tax reliefs. So despite £7.4 billion of relief being claimed last year, the UK government expected more to be claimed. So what that means, there are many companies out there that may be carrying on projects that qualify for research and development relief. So if you have a limited company and you're trying to be innovative and you're carrying on a project where there is some sort of advance in technology that you're trying to achieve, then you really should be speaking to us to see whether that project qualifies for research and development tax relief. Because what it means is for companies that are profit making, it can massively reduce the profits that are taxable. And for those companies in their early stages that are loss making because of this expenditure they're incurring, they may be able to claim what's called a tax credit, which means money is paid by the government to the company, and they can use that money to reinvest in that project. So further form of planning at the end of tax year for businesses is to look at capital gains. So every year, most people have what's called an annual exemption. And what that means is the first £12,300 of gains is tax-free. So it's similar to the personal allowance. So for the personal allowance, you have a tax-free threshold for income. And for capital gains, you have something similar here. And the tax-free threshold is £12,300. Now, one of the major reliefs that's available for businesses is called business asset disposal relief. And it basically means that you can get a 10% capital gains tax rate on up to £1 million of capital gains. The limit used to be a 10% tax rate on up to £10 million of capital gains, but that limit was reduced to £1 million a couple of years ago. So if you haven't claimed this relief before, then you can actually claim it on up to £1 million. If you have claimed it before, then you have to deduct the amount you've claimed it on before from the £1 million limit. So if you have claimed entrepreneurs relief on more than £1 million previously, then you won't be able to claim this relief going forward. So in terms of other business tax planning tips, so just run through those. So mentioned earlier, lots of increases in taxes, dividend taxes, corporate taxes, a lot of things that are increasing the cost for business. So what we need to do is to look at the way the company is using its money. So first of all, salaries. You could potentially consider the payment of salaries if you're an owner managed business. And that can be thought about at this time of the year if you haven't taken a salary, whether it's beneficial to take a small salary. And that would reduce the corporation tax for a company. And if you have the right level of salary, there won't be much personal tax to pay on that. Also, what benefits are companies providing to directors and employees? One of the things that's really tax efficient at the moment in terms of benefits is electric cars. And given the price of fuel recently, electric cars are even more demand at the moment. So when you're thinking about electric cars, if you're a limited company, owner managed business, then thought should be given to whether the electric car should be purchased by the company versus purchasing the electric car personally, because there are tax reliefs available for those companies that have electric cars. There are generous deductions in terms of corporation tax, and also the benefit in kind for allowing directors and employees to use electric cars personally is quite low compared to petrol and diesel cars. So you could be in a situation where a director may decide to buy an electric car, do it through the company, have a reduction in corporation tax, and have a very minimal income tax charge on their personal use, which would make the overall cost of the electric car much less than had it been purchased personally. So that's the kind of thing to be looking at. Also, many limited company owners take large dividends out. And if they have plans to purchase an electric car, they may decide to actually not take as much out of the company as dividends and use that money instead to purchase an electric car to use personally, which would be a much more tax efficient way of taking money out of the company compared with dividends, which I mentioned earlier are going to be taxed at a higher rate than they currently are. The third thing on here is a share scheme. So share schemes have become very popular over the last couple of years. And the reason why they're popular is companies are obviously going to struggle to pay the market rate salaries to all their key staff, especially with those market rate salaries increasing. Also, businesses need to be aware of the costs they're incurring. So rather than paying large salaries and large bonuses to key people, a share scheme could actually be structured in a way where you're enticing staff with equity, which means you're going to incentivize them, provide them with a sense of ownership, motivate them, which means you're going to be giving value to employees based on what they actually bring to the company. Whereas giving large salaries is not doing that, because you're committed to paying salaries in the long term without any guarantee of the success of that employee. So share schemes have become very popular over the last couple of years, where cash flow has been an issue, and it's a way of attracting key people without having to pay those upfront salaries. And if they are as good as they say they are, then they will benefit from the share scheme because they'll be helping the company to grow. So in addition to how you can remunerate employees and directors, self-employed people should be thinking about making sure that they've claimed all the eligible expenses in the tax year, because obviously they'll be preparing their tax returns following April. So make sure that you've got good records of your expenses, maybe double check records to make sure you haven't missed anything, especially those that are not using accounting software to keep records, because those people, might find it difficult to find all the expenses in the year. In particular, I'm talking about landlords and sole traders. But obviously, if you do have an accounting software, then this should be a lot easier because you're managing your records as you go along. So you should use this time to make sure you've captured all the relevant expenses. If you're not sure about whether something is deductible, then you should be speaking to us rather than discarding something. Earlier I mentioned profit extraction. So rather than taking dividends, there might be other ways of doing that. Now, there are still opportunities on dividends I mentioned. For example, taking dividends before the end of a tax year, where you have a similar level of dividend every year. But if you take a bit more in this tax year without jumping into a higher tax bracket, then perhaps you could do that in this tax year, so you're not suffering so much after. April 22. There might be some limited companies which have been set up recently, or where the directors actually pay the expenses of the business out of their own pocket. So in those circumstances, the company actually owes money to the director. So you might be looking to use the amounts the company owes to the director, and the director could actually take profits of the company and repay those loans. The repayment of the director's loan is not taxable, so that could be a way of getting money out of the business without triggering further taxes. So that's an overview of some of the things that can be done by businesses. But obviously, the end of a tax year is very relevant to individuals, as their taxes are based on the actual tax year itself. So we're going to run through some personal tax pay that is typically done at the end of a tax year. So first of all, for those that are married or in a civil partnership, they're able to transfer assets between each other without triggering capital gains tax. So if you have a situation where one partner has a much higher level of income than the other partner, so for example, one partner has an income of 200,000, say, and the other partner doesn't work, and their income is zero, thought could be given to how investments are held by those two individuals, and perhaps transferring some to the lower earning partner to make use of their personal allowance, and also to make use of their lower income tax band as well. Here I've also put in something about individuals where their income is between 100,000 and 125,000. And the reason why that's relevant is once somebody's income is more than £100,000, their personal allowance is actually reducing. So what it means is that for every £2 of income in excess of 100,000, they lose £1 of their personal allowance. So once you reach the £125,000 level, you pretty much lost most of your personal allowance. So if you are in a situation where your income is going to be staying between 100,000 and 125,000, and you do have assets that can be transferred from one partner to another, then you could be saving the income tax that would have been paid on those investments by the higher earning partner, but that higher earning partner could also recoup some of their personal allowance. And in some circumstances, that could actually save somebody 60% in tax, because they would save 40% on the tax they would have paid on the income from the asset which has been transferred, and they'd also save 20% from recouping the personal allowance as well. Second on that list is also exchanging salary for benefits. So I've mentioned share schemes before. If structured correctly, share schemes could actually enable employees and directors to receive remuneration which is not taxable. And also mention pension contributions as well. So where the company pays a pension contribution to a director or an employee's pension plan, the company is able to claim a reduction in corporation tax, and there is no taxable benefit in kind on the individual that has benefited from the pension contribution. If the individual does not have a limited company, they can make what's called a personal pension contribution, and they receive tax relief via their tax return. And they also receive some tax relief at the time of making the contribution. And this really benefits those that have an income between 100,000 and 125,000. The reason being is when we test whether somebody's income is more than 100,000 in respect of claiming the personal allowance, you can deduct the pension contributions made. So if somebody's income is 110,000 and they make pension contributions of £10,000, they would have recouped all of the lost personal allowance. And what that means is they're getting 40% tax relief on the pension contribution, and also further 20% tax relief because they've recouped the lost personal allowance. So for those people with an income between 100,000 and 125,000, pension contributions are extremely tax efficient, because for every pound you put into the pension fund, it's only going to cost you 40 pence. So it's actually a really tax efficient way to save money. And it's a very simple method as well. Nothing complicated about it either. So dividends we mentioned earlier, we'll keep on mentioning that because of the increases in dividend taxation which are taking place. So as I mentioned earlier, you could bring some dividends into this tax year if you have, if you're an owner managed business, you're a director and a shareholder, then you have the ability to time those dividends so they come into this tax year. So you may want to do that if you haven't taken any dividends, and also those that take a similar amount of dividends every year but haven't actually used all of the tax band they fall under. So, for example, if somebody is a basic rate taxpayer and they haven't utilised all of their basic rate band, they could do so in this tax year, so it reduces the tax on the dividends next year. So yeah, for those that have a relatively low level of taxable dividend income, it could be worth deferring those dividends. So one example of this case is you've actually used the dividend allowance, the tax-free dividend allowance of £2,000. So you may want to defer dividends if you're only planning to take a small amount next year. So you're using the dividend allowance next year as well. So if you have shareholdings where you take a very small dividend, you could plan it so you're just taking that £2,000 per annum, which means you're not having to pay tax on the dividends. Another common technique is to look at situations where the company owes the director. So like I mentioned earlier, the director may have paid expenses on behalf of the company, or they may have transferred something to a company or value. So the company owes the director. Now, what could be done in this situation is the director could charge interest to the company for the amount they owe. And if you're a basic rate taxpayer, you could charge up to £1,000, and the interest received would be tax-free. If you're a higher rate taxpayer, so your income is above 50,000 but below 150,000, you could charge up to £500 of interest to the company and not have to pay income tax on that. So it's quite a tax efficient way of taking money out of the company. Obviously, these are not substantial amounts, but this could be done in addition to the bigger tax paying I mentioned earlier. Stamp duty and land tax. If you are looking to purchase a property or purchase what we call an additional property, then we do recommend you to look at the stamp duty on that. The stamp duty holiday is well and truly gone. So if you are purchasing additional properties, you've got this 3% surcharge, which is applied on top of the usual rates of stamp duty. Anyone that's a non-resident, on top of the 3%, they also have to pay an additional 2% stamp duty as well when they buy a property. So you just got to make sure that, if anyone's a non-resident or you deal with somebody who's non-resident, that you're aware of these surcharges that are applied, because a non-resident person looking to buy a property in the UK could end up paying a surcharge of 5% on top of the usual stamp duty, which would obviously mean that the amount they want to pay for the property might need to be revised. to take into account this increase in stamp duty. So inheritance tax planning, there are a few things that can be done at this time of year. Also things that can be done on an ongoing basis as well. So there are ways of giving money and not having to be paying inheritance tax on it. And the benefit of this is to gradually reduce your estate and not missing out on easy wins each tax year. So charitable giving, if you give to charity during your lifetime, those gifts are not subject to inheritance tax. So they are ways of reducing your estate in the long term. Also, you may be aware or not be aware that if you leave 10% of your net estate to a charity, the amount you're leaving to the charity is not subject to inheritance tax, but it also reduces the rate of inheritance tax on the remainder of your estate to 36%. So if you leave at least 10% to charity, that 10% won't be taxable when you pass away. And you're also reducing the inheritance tax on the rest of the estate that you're giving away from 40% to 36%. So that's a 10% reduction in the actual tax. So giving to charity is actually very tax efficient because you're saving 40% of the amount that you would be leaving in your estate, and you're also saving 10% of the tax payable on the rest of your estate as well. So when you think about giving to charity, it's actually, when you're looking at the net cost of doing so, it's not actually that high compared to other methods. So this time of year, one of the things to think about is the annual gift allowance. So this is an annual allowance for gifting during your lifetime. So everyone has a annual exemption of £3,000, which means you can give £3,000 each tax year. And these gifts are not taken into account should you pass away. So these are very easy ways to reduce your inheritance tax. And if you haven't used the annual allowance or the annual exemption from the previous tax year, then you can use it in this tax year. The unused allowance can only be carried forward 1 year. So if you haven't made any gifts previously, you can only use the prior year's allowance. You can't use allowances from the years before that. So if you haven't made any gifts before, you could be making up to £6,000 of tax-free gifts in this tax year. And then you will have another £3,000 of annual exemption starting from next tax year as well. So the idea here is to make sure you're using these allowances if you have excess funds, because it means that you're gradually reducing the eventual inheritance tax on your estate. And as I mentioned, this is a tax-free allowance, so it doesn't matter how long you survive after these gifts. But if you are gifting more than £3,000, then the first £3,000 is tax-free, and then the excess will be subject to something called a 7-year rule. So it only becomes exempt completely after 7 years. If you don't survive 7 years, that excess may be taxable, it may not. It's dependent upon your personal circumstances. The other thing to be thinking of every year is regular gifts out of income. So if you do have regular sources of income which you do not actually need, so you can maintain your standard of living without this income, what you can do is receive the income each year and then make a regular gifts to relatives, for example, out of this income. And as long as you're establishing a regular pattern and the income is out of surplus income, then you can actually make tax-free gifts which are not subject to the 7-year rule, and you can actually be gifting potentially more than £3,000. So if you have a lot of surplus income, then this is a very useful exemption where you could be given a lot more to relatives. And one of the most common examples of this is to, for example, look at grandchildren and meeting, costs such as education expenses like school fees. So pensions is quite a big thing at this time of year. Obviously giving you a slight overview of that. So if we run through that. So a couple of things to look at is the lifetime allowance. This is an allowance where if you do exceed it, when you draw money from your pension, you can be liable to tax on exceeding the allowance. If you are in a position to take pension income from your pension, then you just need to look at your pension fund and see whether it's exceeding the lifetime allowance. If your pension fund is approaching the lifetime allowance, then you could actually speak to a financial advisor about protecting your pension. What it means is you're not subject to this lifetime allowance charge if your pension funding increases in value above the allowance. But however, it does mean that you're restricted in terms of what you can add to your pension. The annual allowance is something that's available each tax year. So this is the amount on which an individual can claim tax relief on pension contributions. And each year, the annual allowance is a maximum of £40,000, and the minimum is £4,000. And if your income is more than 150,000, including any pension contributions made by your employer, then your £40,000 allowance can be reduced eventually all the way down to £4,000. And also, what you want to be thinking about is if you have been a member of a pension scheme and you haven't used your unused allowances in the previous 3 years, then you could actually use those allowances in the current tax year. And that could actually potentially increase your annual allowance beyond £40,000. So that's something to think about as well if you've been a member of a pension scheme but not made any contributions or any significant contributions in the last 3 years. Like I mentioned earlier, the current year annual allowance is dependent upon your income. So if you have a much reduced amount of income in the current tax year, your annual allowance might be higher than previous years. So it could be an opportunity to look at what amount of pension contributions you can make. So yeah, if you are a higher earner, then it's worth talking to a financial advisor to see what you can contribute. It's quite complicated. But however, if your income is more than 312,000, then your annual allowance is going to be at the minimum of £4,000. So not very high. So this is much more relevant to those with lower amounts of income. So those, for example, having an income of, for example, less than 100,000 or between the 100,000 and 125,000, this could be a useful way to make use of these allowances and save a lot of tax at the same time. One of the benefits of a pension is the pension fund itself is exempt from tax. So if you do have contributions into a pension, they're invested inside the pension, then the income and the capital gains realized by the pension fund are tax-free. So that's enabling your investment to grow quicker because there's less tax being paid on income and gains. So as well as getting the tax relief, it also helps to accelerate growth in investments as well because of the tax-free nature of the pension fund. So in addition to those that have high levels of income or significant levels of income, you might come across situations where somebody's a very low earner and they do not have any earnings, because the amount of personal pension contributions is restricted to the amount of earnings that you have. So for those that are not earning in terms of their employment income or self-employment income, they could actually make a contribution of 2,880 net, or 3,600 gross, regardless of whether they have any earnings. So this could be, for example, children could start a pension contribution and get 3,600 into their pension every year. Obviously, the younger that it started at, then the more chance they've got of building a reasonably sized pension fund as well. So it's just a case of just making sure that you're not just focusing on the annual allowance for pensions and those that are earning, but also focus on those that are not earning, but there is some spare cash to make contributions into their pension. Also, if you are 55 or over, you may be in a position to draw income from your pension, and you can take it to 25% of the pension as a tax-free lump sum. And you could also plan your income from the pension, because once you've used your 25% tax-free lump sum, any further income is taxable. So you can plan as to how much you take out each year, so that you're not unnecessarily going into higher tax bands. So if you plan it properly, then you could spread your income over a longer period and pay less tax on it, as opposed to taking lots of income very soon and paying higher rates of tax on it because your income has jumped up in the year. So in addition to pensions, there are other ways of investing in a tax efficient manner. So just got a list of a few commonly used ones. So ISAs have been around for a long time. You have an allowance of 20,000 that you can put into an ISA, and you can actually invest within the ISA, and you can actually have tax-free income and gains. So consider using your ISA allowance if you haven't used it in this tax year. And also what you can do is, at this time of year, use the current year's ISA allowance and then use the following tax year's ISA allowance as well. So you can make a 20,000 investment this month, and then after 6th of April, invested a further 20,000 into the ISA as well. So if you haven't invested in ISA before, then you could potentially be putting in £40,000 over the next few weeks into an ISA without breaching any limits. And as I mentioned earlier, you can invest in the ISA in a tax-free environment. So, for example, you could invest in a cash ISA, but also invest in a stocks and shares ISA as well. Obviously, the stocks and shares ISA is more risky, but it does produce potentially capital gains that are tax-free. So these are all things to think about with a financial advisor. I mentioned share schemes before. So this is to incentivize employees. It also could apply to those that are looking for roles in key positions. So you might be somebody who's looking for a role in a key position in the company, and a share scheme could be an idea you may propose to a future employer, which might entice them to give you a better package overall. So it's not just a case of, should the company offer a share scheme to its employees, there may be an individual who's looking for a key role in a company, and you could actually propose the idea of a share scheme to your future employer. And that way that you could negotiate the terms of your remuneration and also try to have a vested interest in your employer as well. Third one on the list is EIS and SEIS. So an EIS is what's called an enterprise investment scheme, and an SEIS is similar to EIS but for smaller companies. So it's called the seed enterprise investment scheme. And what these investments do is allow individuals to invest in limited companies that have UK businesses, and it allows those investors to claim an income tax reduction. So, for example, if you invest in a company under EIS, then you'll need to you'll need to think about whether you could actually claim a reduction in income tax. And one of the things to think about is, what is your income tax bill before making the investment, and what's the income tax bill after making the investment? So with EIS, you can reduce your income tax bill. If you can think about your investment, let's say you invest £100,000, and with EIS, you can claim a tax reduction of up to 30%. So you can reduce your income tax bill by up to £30,000. So what you need to think about is, do you actually have an income tax bill of more than £30,000? If the answer is yes, then an EIS investment could be beneficial. If your income tax bill is only £10,000, then you're not going to get the full benefit of investing £100,000 into a company under EIS, because you could only reduce your tax by £10,000, not £30,000. So you might decide, actually, I'm not going to invest £100,000 into the business. I might just invest £33,000 instead, because I can only reduce my tax by up to £10,000. So when making these investments, you've got to be thinking, is it tax efficient for me? And the way to understand that is to look at your income tax bill should you not make the investment, and look at your income tax bill after making the investment. So gave an example under EIS, it reduces your income tax bill by up to 30% of the amount invested. So you invest £100,000, you can reduce your tax by up to £30,000. Now, with EIS, you can look at your income tax bill for the current year, so the year in which you make the investment, and then also look at the tax bill for the year before you make the investment. So if you're making an investment today, you look at your income tax bill or your projected income tax bill for this tax year, and you also look at your actual income tax liability for the previous year. And if you're in a position where your income tax bill for this year is, say, £10,000, and you're thinking to yourself, well, if I invest £100,000, I'm only getting £10,000 tax relief, so I might want to reduce it. What you'll also need to think about is, what was your tax bill in the previous year? If your tax bill in the previous year is £50,000, what you can do is carry back some of the investment to the previous year. So you're making the actual investment in this tax year, but for tax purposes, you're treating as if you made it in the last tax year. You can reduce the income tax bill of that previous year, that £50,000 tax bill, and you can reduce it by up to £30,000. So in this situation, the £100,000 investment makes more sense. But if your income tax bill of the previous year was zero, and it's £10,000 in this tax year, then the £100,000 investment doesn't quite make tax sense. So in addition to EIS, I mentioned SEIS. The key difference in terms of tax relief is that instead of getting up to 30% tax relief, with SEIS, you can get up to 50% tax relief. So let's say you make a £100,000 investment in a company under SEIS, you can reduce your income tax bill by up to £50,000. Now, you need to have £50,000 tax bill to do that. So you just need to consider whether you do have that liability. Also, you can carry back the investment to the previous year. So if you did have a large tax bill in the previous tax year, then you can reduce that by carrying back the investment to that tax year. In addition to income tax relief, you can use these investments to save capital gains tax as well. So there are various tax efficiencies, and also the shares that you hold in these companies, they're exempt from inheritance tax once you've held them for more than 2 years. So there are various taxes that can be saved by using these investments, and that's why they are popular. Also mentioned a venture capital trust as well. A venture capital trust is generally a fund which has many EIS type companies in them. So you invest in a particular fund, which then spends the money on various EIS qualifying companies. So you're actually investing in more than one business at a time. With those type of investments, you can reduce your income tax bill by up to 30%. So that's a run through of the common techniques. So if you have any questions, please fire away. I'm happy to answer those. I'm hoping you found it very useful, and I'm hoping that you're finding this enlightening as well, given the changes that are coming up in the next few weeks and also in the upcoming year as well.
Okay, thanks, Nimesh. Don't think we've got any questions in the Q&A. We're slightly over, but I'm sure that's not a problem. And if anybody's got any further questions, hopefully they can direct them to you and to your email, which is nimeshp@grumberg.co.uk. As I mentioned earlier, there'll be a recording available of the webinar on the website later on today. And we look forward to our next one. Thanks very much for the presentation, Nimesh.
Thank you very much.